Hey guys, Kelvin here. Today I'll be sharing with you what I think is the best investment strategy out there. It has the lowest risk, requires the least amount of effort and no skill needed, and it will allow you to outperform 95% of the finance professional out there. In fact, this method was recommended by Warren Buffett himself, the MVP of stock investing. And if you use this strategy long enough, you can be rich enough to say this:
钱是世界上最容易得到的事情。
Or be that father who can give his son a small loan of $1 million. Or just be any rich guy who will gently tap that like button. The strategy that I'm talking about is investing in an index fund. So what is an index fund? An index fund is basically a group of investment used to represent a certain market or industry. Take for example the S&P 500 index measures the stock performance of the 500 largest companies in the US. So let's use a hypothetical scenario. You are in a Pokemon tournament with $1,000 and you have to choose the winning Pokemon. So you took that $1,000 and you bet it on Snorlax, which you think has the highest chance of winning. What if in the middle of tournament Snorlax just goes to sleep and you will be losing that $1,000? A solution to that, instead of trying to bet on one Pokemon, you take that $1,000 and you spread it among all of the Pokemon. That way, you get an average winning of all of your bets. This is basically an index fund. So in the real world, instead of trying to find that one winning stock, you can just buy into an index fund and own the top 500 companies in the US. So let's talk about why is it such a good investment that even Warren Buffett himself recommends it. The first benefit of an index fund is that it has very low fees. An index fund is also known as a passively managed fund, in which stocks inside it will get automatically rebalanced and readjusted over time. The management fee of an index fund is as low as 0.03% annually. On the other hand, there is also something called an actively managed fund, also known as a mutual fund, in which the fund manager will hire an army of professionals to help him manage the fund, and the expense of all of this will be passed down to the investor. The cost can range anywhere from 1% to 3%. Despite all of that, studies have found that most mutual funds fail to outperform a standard market index by a wide margin over long periods of time. And this is considering that mutual fund has the best of the best with the Ivy League educations, decade of experience, and sophisticated trading tools. This will bring me to point number 2. An index fund has historically delivered higher returns over the long term. It has been found that 95% of the finance professionals out there failed to outperform the market over a 20-year period. And this number is even worse for an individual investor. One of the reasons is that investors tend to trade emotionally. They are always trying to time the market, trying to buy low and sell high, but instead bought high and sold low. And all this will eventually lead to a much lower return. In an interview in 2017, Warren Buffett himself said that it is a mistake to do stock picking for 99% of the people out there. In 2007, he made a bet of $1 million against hedge fund managers that they couldn't outperform the market over a 10-year period. And guess who won? Despite the 08 crash, the index fund made a 7.2% return versus the hedge fund which just made a measly 2.2% return. Third benefit of an index fund is that it is very diversified. By just buying into one index fund, you will be owning the top 500 companies in the US. And even if one failed, you will have 499 other companies to boost you up. So essentially, instead of trying to bet into one stock, you are betting that the entire market will rise as a whole. This will give you a peace of mind, as you no longer have to worry about random president tweets early in the morning or keeping track of every news that may affect your stocks. And on top of it all, you no longer have to spend time to find the best stock which you think will give you the best return. I know my limitations, and if most of the professionals out there can't do it, what makes me think that I could do it? Instead, I'd rather save my time and use it on other places which I know will give me a much higher return. You might be saying, great, how do I start? Introducing 3-Fund Portfolio by Boglehead. What the 3-Fund Portfolio consists of is obviously 3 funds. First of all, a local market index fund, an international index market fund, and a bond index fund. This will give you the broadest diversification possible. because you'll be owning 3 highly uncorrelated markets. In the event that one fund fails, you still have 2 other funds that will back you up. For US residents, you can invest in VTSAX for the local market fund and VTIX for the international market fund and the VBTLX for the bond market fund. For non-US residents, as there is a 30% withholding tax, it is much better to invest in the Ireland domiciled version of this index fund. You can invest in the BUSA for the local market fund, VWRD or IWDA plus EIMI for the international market fund, or AGGG for the bond market fund. For people living in Singapore like me, you can invest in the Singapore ETF for the local market fund. For the international market, you can invest in IWDA plus EIMI also. For the Singapore bond market, you can invest in the Nikko-M bond ETF. You can decide how you want to adjust the weightage for each of the fund according to your preference. Take for example, if you want to increase your exposure internationally, you can increase the weightage of your international index fund. Or if you want to play safer, you can increase the weightage of your bond index fund. For me personally, for the local market, I do stock picking myself. As for the international market, I use IWDA plus EIMI combo. I do not invest in the bond ETF for now because I feel that I have enough of a time horizon to recover for any market crash. So the strategy is just buy and hold. It is that simple. Every year, you will have those experts that will tell you a recession is coming. And I mean every single year. But instead, the market has gone up over the long term. And you know what? Eventually, they'll be right and they will say, aha, see, I knew it. And you know, even the broken clock will be right 2 times a day. The truth is, no one will know a recession is coming. It's much better off investing immediately rather than trying to time the market. A study by Sharp showed that by investing immediately and consistently, you'll be getting a much better return than trying to time the market. That's all you just need to do. Buy and hold, buy and hold, buy and hold. Just keep buying and holding the same funds over and over and expect to grow your funds the same pace as the market. That's all from me today. Comment down below. Let me know what you think or what topic you want me to talk about. Tap the subscribe button as I'll be sharing more topics in the future. That's all.